Hello, class. Today I'm going to wrap up chapter 5 by walking through examples from financial budgets. That includes the last couple of questions from the chapter 5 sample problems part 1, as well as some problems from the sample problems part 2. So the financial portion of the budget includes the budgeted income statement, the balance sheet, and the budgeted statement of cash flows. Essentially, the cash budget walks through when you expect to have your cash come in and from where. And so it looks at things like delayed receipts of credit sales and things like that. Now, the capital expenditures budget walks through expenses that you planned to make for long-term assets like equipment, property, real estate, things like that. The cash budget looks at the timing of cash flows that are coming in and out. And so we're not going to do much with uh, the capital investments budget, but we are going to talk quite a bit about the cash receipts budget. Here we have a company that has total sales of $250,000 in their first quarter. And they have an accounts receivable balance at the end of the prior year of $70,000. So in that first quarter of those sales that they have, they expect that 30% of those sales will be cash sales. They will receive those immediately. So $250,000 times 30% is $75,000. And then they expect to collect approximately 70% of the sales that are credit sales in first quarter also, or I'm sorry, 60% of their credit sales will be collected in first quarter. Now, 70% of their overall sales are the credit sales, right? So if we look at that then, right? So 250,000 times 0.7 is equal to 175,000. So in total, they're going to have 175,000 in credit sales from the 250,000, right? And of those, 75,000 will be collected during first quarter, which is 60 per, or I'm sorry, whoops, wrong math here. Hold on. 60% of the 175,000. So whoops, times 0.6 is 105,000, right? So they will collect almost 2/3 of their credit sales during that same quarter. So within 30 to 60 days, right? And then the remaining 40% will be collected in the second quarter. So this 150 plus the 70 here is the 175,000 total of credit sales from that period. And you expect, and they're saying that each quarter, 60% of the credit sales will be collected right away, and then the remaining 40% in the next. You're going to take your sales times the credit percent, and you're going to take that times the percent collected for each period. Okay. So that's the formula that you're going to want to use to figure out your collections for each period. Now, in this second quarter here, we're collecting this money that was from sales in the previous quarter. And then these are the cash sales and the 60% of credit sales from this quarter. And then the remaining 40% from that quarter are in the next quarter. So just like same thing, each quarter, 40% of their credit sales get delayed until the next quarter, right? One second here. Okay, so let's walk through an example of that in our sample problem number 10. So looking at Problem number 10. We have Berry Company, and they expect total sales in January of 359,000, and in February of 405,000. Okay. And their collections are as follows. Okay, so 80%, 80% in month. All right. And then they're going to have 10% next month, and then 6% in 2 months, and then 4% never collected. Okay. So I'm just going to put like bad debts over here. So from that, we're going to take for each month, we're going to have 80% of this 359. So 0.8 times 359. And then in February, we're going to have the 10% of January, right? So this here is 10% of January. And then we're also going to have here 80% of February here. And then 10% of January. Now, so in this period right here, then we're going to have 6% of December that will get collected in February. So if we say November sales were 350,000, I'm going to put actually a little insert here there. So this is going to be 10% of December and 6% of November that will get collected in January. Okay. So November sales were 350,000. So 0.06 times 350,000. And then December is 325,000. So we're going to collect 10% of that in January. And then in February, 2 months out, 6% is from December, right? So December, January, and then it gets collected in February. So 325,000 times 0.06. Okay. All right. So here's the numbers. Let's plug in our sales here. So November credit sales collected in January would be 21,000. And I did this in order like that they had it in here. So we want to make sure that we are getting this in the right order. So they're doing oldest, newest here. So this would be the 21,000. The credit sales from December collected in January would be the 32,500, right? And then the other December sales here get collected in February. That's 19,500. And then January sales collected in January were the 287,200. And then January collected in February is this 35,900. So you can do it either by saying, okay, what do we have left from November and when is it getting collected? Okay, January is 2 months out, so we put it here. Then they're saying, all right, what do we have left from December that has to get collected and when? And it's like, okay, that portion of December is collected in January. This portion is collected in February. So different ways of doing this. You can either start with months that have outstanding collections and when will they be collected, which is the order that they do it here, or you can do it in this order that I did it over here saying, okay, what all am I collecting in January? Okay, 80% of January sales were this month. This is from 10% of December, the 6% of November. Whatever order makes sense to you to lay this out is the order that you can do this in, okay? Now, in February, if it's a February sale, obviously none of that will get collected in January. So the 80% of February is getting here. And then ultimately we just add this all up, right? So January collections are going to be equal to 21,000 plus 32,500 plus 287,200. 340,900. And then in February, we're going to collect 19,500 plus 35,900 plus 324,000. So 379,400. Okay. Now, here we're going to say, all right, what is in our receivables at February 28th? Well, February 28th, think about it, we're going to have the remainder of February, we're going to have some from January. So January, part of it was collected during January, part of it was collected during February. So we're going to have the remaining part that will get collected in March that will be left. So, and that portion is going to be 6% of January. So that will be January collected in March. Let me just double check my math on that. 300, oops, that's it. There we go. So 21,540. Formula here so you can see what it is. No, I put a negative sign in there. Okay, so then in February, we've also got 2 months worth of additional collections. We have February that will be collected in March and February sales that will be collected in April that are left. Okay, so that's going to be percent of February. That's going to get collected in March. And then we're going to have 6% of February, 0.06. That is going to be collected in April. Okay. And that's how we calculate that one. That gets us to a total of 86,340. That is still sitting in accounts receivable as of February 28th. Okay. Now, this next problem is another example of a cash receipts journal here. Okay. So, or budget rather. Whoops. So, Barnes Company, I'm sorry, this is cash payments. Sorry. So that was the cash receipts budget in the last one. Now we're going to look at a cash payments budget. So we have direct materials purchases for distribution of 191,990. So we're going to purchase in January, and then we're going to purchase 138,610 in February. And so these direct materials purchases would be coming from our purchases journal that we did, or our purchases budget that we did earlier in the chapter. Now, let's say that we pay for our direct materials 60% in the month, and then we pay for 40% in the month after. Okay, so for January, we purchased 191,990, and of that, 60% is that amount, and then 40% is is that amount. All right. And if we highlight those, look at the bottom. Yep, we got the total correct. And same thing here for February. We're going to figure out our 60% and our 40%. Click for, oops, D4 should be. There we go. So that would then, so these are the percentages, right? What are we going to collect in January and February? Well, we also had coming into January $75,000. Okay, so account payable on January 1 was $75,000. Okay, and we know that anything that's receivable, we just have a 1 month delay. So this is going to definitely get paid in January here. And then January direct materials paid in January would be the $115,194. And then that $76,796 is getting paid in February. And then in February, we're just paying this portion of February, that 60%. So it's basically just understanding, like, it really does help to make a spreadsheet here to map this out, to make sure that you are keeping track of like where all these numbers go. And then you could almost, even if you have a bunch of months, like highlight when they're getting collected, okay? Because there is a multi-month example that is out there in your homework. So just keep track of that. All right, so what we're collecting then in total here is these two in January, so 190, 194. And then in February, we are collecting, oops, this amount, just adding those two together, okay? All right. And then they're asking, what is our accounts payable balance in February 28th? It's going to be the amount that gets paid in the month after, that will get paid in March. So that would be the 55,444 that we collected. And I don't like that they put that in this column. It really would be nice if it was over here and make it a little clearer, but it is what it is. All right. So that is our cash payments budget, right? So now we're going to combine these together and we're going to look at a combined cash budget for a company here. All right. So we've got Booth Company here, and this is their budget data. All right. So they've got their sales, cash receipts from customers, cash payments from direct materials, direct labor costs, manufacturing overhead costs. So our beginning cash balance that we have here, whoops, I clicked on there, I'm getting click happy here. All right, so assume direct labor costs and manufacturing overhead costs are paid in the month incurred. Okay, so direct labor and manufacturing are paid in month incurred. Additionally, assume Booth has cash payments for selling and administrative payments, including salaries of $40,000 per month, plus commissions that are 1% of sales, all paid in the month of sale. All right, so some of this stuff we can just plug right in here, okay? So we have $12,500 on hand at the beginning of January. And we are anticipating that we are going to have these cash receipts from customers. So this would be like that total from the bottom of our problem 10 that we did, right, for cash receipts. This is assuming we've already done that cash receipts schedule there, okay? So that gives us cash available totaling those two amounts. So 400 and, let's see, oops, did I? 12,500 plus 443,500 Oh, wow. Why did I add 500 there? That's a typo. Here we go. 455, 500. Okay. That's the total of those. That gives us our cash available. Now, for purchases of direct material, um, let's see here. We're going to plug that in here. And our direct labor are paid in the month incurred. Okay, so that amount there. And manufacturing overhead are paid in the month incurred also. Includes depreciation of 900 per month. Okay, so depreciation, by the way, is not a cash expense. So we need to subtract out to arrive at what we would have in our manufacturing overhead. Okay. Our manufacturing overhead is going to be that 55,058. We're going to subtract the non-cash depreciation expense because cash for the depreciation part, that was expended when we purchased whatever that fixed asset was and would be on our capital budget, capital expenditures budget. So we want to subtract that out. So that gets us to 54,158. And then selling and administrative, they said that would be during the current month, and that's going to be 40,000 plus 1% of sales. Okay. So we're going to have 40,000 and then 1% of sales. Sales are 529,000. 1% of that is 5290. 45,290 then, adding those two together. All right, so the total cash payments then is going to be all of those added together. So So 415,082. All right. So then our cash available, we're going to take our cash available and excuse me, subtract out our cash payments. All right. So this is cash available. That's our cash payments. That gets ending cash. Available minus cash payments gets us our budgeted ending cash before any borrowings. That's going to be 40,408. I'm sorry, 418. Now we have a minimum cash balance that we want to have, which they tell us up here is 20,000. We subtract that out, then we actually have excess cash here of 20,418. So we don't need to borrow anything in order to make sure we have that. So ultimately, the purpose of this is to say, hey, are we going to run out of cash? And if so, then we need to borrow some cash to make sure we have our minimum cash amount. Okay. Now, it doesn't look like we had any cash repayments from a previous borrowing that we need to worry about in this month. If we did, we would include that here to show that we were going to be repaying. Okay. We have no effects of financing, which would be the difference between borrowing and repaying. Okay. So our ending cash balance then will be our 20,000 minimum plus the projected cash stuff that we had. Okay. Which is this amount right here. We take this ending cash balance before financing and then add in any effects of borrowing or repaying debt. Okay. So we're good there. Now, whoops, what did I put? 443. Oh, yeah, 443. That was when I did my typo. Let me fix that. Okay, so now we're going to look at February here. I'm going to move that over so we can see February. Okay, so our beginning cash balance for February is going to be our ending cash balance for January. All right. And then our cash receipts are going to be what they gave us here again. So cash available will be 4418 plus the 502,200. Okay. No, and then we're going to add in, okay, purchases for direct materials and our direct labor, manufacturing overhead. We're going to subtract out our depreciation again. So going to be 53,922 minus that 900. And then our selling and administrative is going to be the same thing, 40,000 plus 1% of sales. And so that gets us to 45,680. All right. And then so our total cash payments then are going to be adding these up right here again, right? 372, 334. So then our cash balance is going to be our cash available again minus our cash payments, which gets us to 170,284 minus our minimum cash balance means we have an extra payment this month of dividends. So we're not going to need to borrow. And again, we don't have anything to repay. So our total effects of financing will be 0 on here. And then our ending cash balance is going to be the beginning cash balance, or I'm sorry, right here, just the 170,284. We don't even have to do anything with that. All right, so that's how you prepare your cash budget. And they're saying, okay, will they need to borrow cash by the end of February? They will not, because their ending cash balance before financing is greater than their minimum cash balance required. So if this balance here was lower, like if it was 0 or less, then they would need to borrow in order to make up for that. And then we would need to also examine, like, hey, what did they say about our repayment plans for that too? Okay. And that is it for the sample problem part 1. I'm now going to jump over to the sample problems part 2. So for the sample problems part 2 in this chapter, I did skip out a couple of problems here. Whoops, got to go back and log in. Let me just pause quick and get that. Okay, so problem 1, by the way, is just a review of what is the order that you're going to be doing your sample problems in. So I'm going to skip that and I'm going to move on to the next problem here. And actually, I skipped the sales budget one in the problems too, so you can skip that one. I wanted to just stick to the problems where we were looking at new items from the chapter here. So I'm going to take a look here at this inventory, purchases, and cost of goods sold budget. So looking at this, all right, so an inventory and cost of goods sold budget. Let me find it here. Slide for you. Jumping back to a previous example or a previous budget we looked at. So for inventory purchases and cost of goods sold, they're saying you want to have, in this example, cost of goods sold is going to be 70% of your sales because they know typically how they price out their goods. And this is being done in preparation for a putting together a budgeted income statement for a period. All right. So they're saying we know what our budgeted sales are going to be, which we did way back in our original sales budget. Our cost of goods sold is going to be roughly 70% of our sales in this case. So they are taking each month's sales amount and applying 70% of sales to it. And they're adding in their desired ending merchandise inventory there to figure out the total merchandise inventory that was required during the period. So their desired ending inventory that they want to have in this case is $20,000 plus 80% of the following month's cost of goods sold. Okay. To make sure that they have adequate ending merchandise inventory for this merchandiser. So they take that merchandise inventory that is required, they subtract out whatever their planned beginning merchandise inventory was, and that tells them that what their purchases need to be. So this is an example for a not a manufacturing company, but for a merchandiser who is buying and reselling goods. All right. So if you're looking at a merchandiser, then you don't need to be manufacturing everything. You just need to go out and buy it. Right. So it's kind of similar to a purchases budget that we looked at in our earlier examples in this chapter. So let's jump back to our problem here, right? Okay, so we've got this company here, and here are their expected sales for cash and credit. So I'm going to go ahead. I'm going to make this a little wider here so I can see this whole box there. All right. For their cost of goods sold budget, we're going to take our cost of goods sold based on a percentage plus our desired ending merchandise inventory, and that's going to get us to our total merchandise inventory required. And then we're going to subtract from that our beginning merchandise inventory to arrive at our budgeted purchases. Okay. So let's see here. So for our cost of goods sold here, let's see here. These are our total sales. And oh, here we go. Additional information. Okay, there we go. I was like, there's got to be more information here. Okay, so cost of goods sold has been 40% of total sales in the past. We're going to take our sales and we're going to multiply it times 40% here to figure out what our cost of goods sold should be. Hmm. Oh, whoops. Let's grab these. Move them up one. All right, and these are going to be 40% of sales. Okay, so that gets us to 56,000 here. Our desired ending merchandise inventory. Let's see. Each quarter's ending inventory should not be below $5,000 plus 10% of cost of goods sold for the final. It's going to be $5,000 plus 10% of the following period's cost of goods sold. Okay. Okay, so for that, then we're going to need We need to know the cost of goods sold for third quarter too, right? Okay, so that and we expect sales of 240,000 in fourth quarter. Okay. So we need to know the cost of goods sold for that period too. Okay. All right. So our desired ending merchandise inventory for here is going to be 12,600. So that means that we want to have inventory required is going to be the cost of goods sold plus the desired ending. And our beginning merchandise inventory is going to be 38,000, which they provided us down below. So I'm going to take the inventory required minus our beginning inventory to get our budgeted purchases. So 30,600 then for that period. Okay. So now I've done all of this math here that we need. So now our beginning inventory is actually for quarter two is going to be the previous quarter's desired ending inventory. Okay. And that's going to be true of this also. And so because I have this coded, I can just drag this right over here. And we now have everything that we need for this one as well. I'm not going to, you can pause the video here to get these numbers. I'm not going to type them all in here because, well, actually I am because we need the 9 months total here. Okay, so. Oh, whoops. Yeah, sales desired ending. Oh, whoops, I started on the wrong one. That's why. Got faster than I was reading here. So then from there, our total cost of goods sold budget is just adding up these three here for the 9 months, which gets us, if I highlight those down here, you can see it's 198,000. All right, so that is a inventory and cost of goods sold budget for a merchandiser. Next, I'm going to look at a selling and administrative expense budget because this will help with an income statement budget also. So we have Slate Incorporated, and they are selling tire rims. And their sales budget and inventory purchases and cost of goods sold are as follows here. So they're telling us that as far as cash collections go, 20% of our sales are cash sales, 80% are credit sales. They've given us our cost of goods sold, desired ending merchandise inventory, and down here. We have everything from our sales budget and our cost of goods sold budget that we would need for this problem. And so they've divided out here for this selling and administrative expense budget, variable and fixed expenses. So we want to take a look here and see what we've got here. So we have some flat amounts here. Let me just disappear this. And we've got some items that vary based on sale. Okay, so items that change based on sales will be considered variable expenses. So we're going to have commissions and miscellaneous expenses that vary based on sales. And then for fixed, we're going to have the rent, salaries, and depreciation here. And so let's just do those fixed ones first, because they are going to be the same all the way across here. And and 1 second here, I'm wondering, let's see, you may have different numbers than I have here, so just be aware of that. Just making sure that I call that out because I have rent here of 2,000. Oh, it's 2,000 per month, but this is for a quarter. Sorry, so 6,000. Yeah, so we got to multiply that times 3. By the way, this is monthly, and we're doing quarters, so watch out for that. For the year, we're going to have, or for the 9 month total, we're going to have 18,000 here. Okay, so then for salaries, $4,000 a month. So 4,000 times 3 is 12,000. And then depreciation is $1,000 per month times 3 is 3,000. So 9,000. Okay. So 18, so 21,000 per month, or 63,000 for 9 months. Okay, so those are all of our fixed expenses. So now we need to look at, so our commissions are 5% of our sales. So let's take a look at that. Okay. So our sales, um, we're going to be using the amount that we actually sell here because your commissions are going to be based on what you sell. So total sales, 140,000, 190, 165. All right. So commissions are 5% of those. And then your miscellaneous expenses are 2%, so 0.02. Okay, so the total variable is going to be the commissions and the miscellaneous. So we'll get all those in. Okay, I got that. And then the total selling and administrative expenses are going to be the variable plus the fixed. Okay. The 21,000 per month for fixed. So if I take those variable ones and just add the 21,000, that will get me my total selling and administrative. All right. That is it for the selling and administrative expense budget. From there, I actually skipped the cash receipts one since we did those on, since we did examples of those in the previous section of the video. So you can go ahead and complete those if you wish for extra. I'm just going to double check to make sure those aren't skipped in the previous, but these last three problems that are out here, there's two cash receipts ones. Oh, there's one last problem here. So information technology has made it easier for managers to perform all of the tasks except for and that would be removing budgetary slack from the budget because that's a behavioral issue. So you can't solve that with information technology, right? Because that's the budgetary slack that we talked about in a previous class session. That's all due to people wanting to build in extra padding and whatnot into the budget. So, okay, let me just go back here and I'm going to just double check the problems that I have assigned here. 1 second. Yeah, so since we did cash budget examples on the sample problems part 1, I'm not going to do that one last problem that should appear for you, but that one is out there for you in case you want to get more practice on that cash budgeting. Please let me know if you have any questions. Thanks.